Right. We are less than a fortnight away from the union budget, the last full year document from the present government. And while a lot has been said about the possible agri or the rural focus, the one thing that keeps on propping up in the minds of almost all the market participants is whether we will have long-term capital gains tax make a comeback. What will the impact be of any kind of fiscal slippage, if at all it comes over? So joining me to talk about all of that and more in our special episode of Budget 18, Return to Confidence, are two market veterans, Hiren Ved and Saurabh Mukherjea. Need no introduction. Gentlemen, both of you, thank you so much for joining in and taking the time out. Hiren, let me start off with you. Will it be a budget that will be akin to a pre-election budget, or will they stick the stance of what they've been doing well over the last couple of years, which is do what is necessary?
I think if you look at the history of all NDA governments, right, I think they've kind of stayed away from populism in the budget. And I think if we give them some credit that they are smart enough, then they know that all the rating agencies are looking at them, the entire financial market, the bond markets are looking at the budget. My sense is that they will stick to the fiscal prudence, not do anything that will shake the confidence of the markets, to say that there's massive populism, so on and so forth. I think the good thing about the budgets in India is that everybody goes into the hyper mode around the budget, and then post the budget is over, nobody really cares. So I'm just trying to be cynical, but I'm saying that if you want to be populist, you can be populist outside of the budget. You don't need to do it inside the budget, and you can keep a clean cut. But having said that, my sense is that if you read between the lines of what Mr. Jittery has been saying, and the few sound bites that you get, is that they don't want to stray away too much from fiscal prudence. So I think the math will be okay. Now, whether you believe that math or not, that's entirely up to everybody in the markets to decide.
What is okay? And I'll come to Saurabh as well on that, but what is okay?
No, I think the big figure that people are looking at is the fiscal deficit number, right? I mean, I think that will be more or less in order. So they will look to go from 3.4, 3.5 this year, I mean, the year that went by, to 3.2. So they will show that they are on the glide path to a reasonable fiscal deficit number. And they'll take credit for maybe a largish sum on disinvestment, because they can prove and say, look, we told you we'll do this much, we've done better than that last year. So now we're taking it even higher. So, I think last year's figure was 75,000 crores. They can be more ambitious and say, can we do a lakh and 10,000 crores of disinvestment this year? That is possible. And then, the GST revenues, they will say that, it could be buoyant in the next financial year, because we are ironing out all the issues this year. So next year, you should have a good revenue number. And you're done.
Yeah, well, let's wait for those numbers as well. Until now, you speak to tax experts. There's no clarity on that. So we'll be watching out for those numbers too. But Saurabh, the same question actually before we move on to other topics. Are the equity markets, and you can argue the bond markets have a different perception here, but are the equity markets already discounting some bit of a move away from 3.2 to maybe a 3.5 number for the year, and then FY19 moving back to a 3.2, 3.1? Is that the nature right now?
I think most bond and equity market investors seem to be focused on 3.4, 3.5. The 10-year bond yield running up since August from 6.4% in August to around 7.2%. The 10-year bond yield tells its own story. So I think 3.4, 3.5 is what most market participants are expecting. It's not obvious that to me that's any great disaster. And in the context of Indian budgets, as Hiren was saying, this is actually fairly fiscally conservative. My reckoning is even for year to March 19. The government will broadly stay in this ballpark of a budget deficit around somewhere between 3.2 to 3.4, which again will be par for the course. Where I think there'll be a lot of verbiage, a lot of sort of noise will be about how much the government cares about rural and about the weaker sections of society. My reckoning is there'll probably be announcements about agri sector, MSP, how to enhance the minimum support price construct. Almost inevitably, there'll be the sort of the required announcement on low-cost housing and so on. So there'll be plenty of heat and noise around pro-poor policies. But the overall thrust of the policy, as Hiren is saying, the overall thrust of the budget will be fairly fiscally conservative, given that we're only 13, 14 months away from a general election.
So one question is, and either of you, one question is whether there is a push to rural and therefore he needs to go away from the mentioned glide path or stick to what is conservative estimates on the fisc. We did a panel of some of the top CFOs in the country, and they had to, all of them were saying that they believe that if at all there is any kind of investment that has to be done, private sector is not going to do it. It has to come in from the government side. Keeping in mind that as well, and the fact that he has to give infrastructure the much needed push, low-cost housing the much needed push, would the markets be happy with the 3.5 is my question. Does it work to the benefit of FY19 if there is some more spend done in order to, give a bit of a jump start? Either of you.
So look, I think we've long ago left the era where the stock market will suddenly be cheered if the budget deficit announcement for FY19 was very high. Remember, the government accounts for barely 15% of overall capex. So you're right, absolutely right, that the capex cycle has been weak for 3-4 years. But I don't think anybody in their right mind believes that the government has the firepower to suddenly rev the capex cycle into life because of the sheer paucity of our fiscal revenues. Central government tax to GDP is a pathetic 11.5%. What are you going to do with that much money, right? You can't really be expected to kickstart a cycle. So whilst there'll be again sound and noise about how the government plans to kickstart the capex cycle, I think most investors are cognizant that the fisc's power is limited, and provided the fisc is reasonably conservative, as we expect it to be, people will go away reasonably happy from the budget. I think the market will be a little disappointed actually if there was fiscal indiscipline. But I don't think that will be the case, and I don't think anybody in their right mind should expect the government to kickstart the capex cycle in what is a free market economy now.
Okay, noise around LTCG started, Hiren. This time around, not so much the government's doing, but it's started yet again. If at all there is some bit of tinkering, will the markets take it very negatively?
I think the good thing is that the debate starts well before it, so everybody's sensitized to the fact that if capital gains tax comes, then it'll be bad for the markets. But I think we have to understand the nature of the market, that the markets will only worry about something that is not expected. I mean, if you have such open debates about capital gains tax well before the budget, my sense is that it's not going to really matter. If
that's
you ask
the idea,
me.
right? Prepare people in advance.
Yeah, I mean, you release a balloon and then you decide whether you want to float it any further. My own sense is that it doesn't make sense, because if you have a big disinvestment program, why disturb the apple cart, right? Secondly, when you bring in long-term capital gains tax, I presume that is in lieu of STT. There's far better visibility on what revenue you can get on STT than you can ever fathom what you would get from capital gains tax, right? So those numbers are not really great, and for a few thousand crores, why risk the sentiment, so on and so forth. But that's the rational side of me speaking. I don't know if there is a symbolic side to this. Some people may argue that this was brought in when equity markets were not doing that great in 2004-05. We were still in the early stages of a bull market. Now, people have taken to equities, to SIPs, the money's in, people have been rewarded, and then, they should be paying a tax. But again, if you ask me from a probability perspective, I think it's a very low probability event, but you never know.
So Hiren will probably still go out and invest big time, even if there is long term. Saurabh, what about your top clients that you guys speak to on the foreign side? I mean, will a probable LTCG impact sentiment or flows towards India? Not that they've been too great in the last 6 odd months any which ways.
So I don't think that too many other large Asian economies which have long-term capital gains tax for equity investors. So we certainly will mark ourselves as the odd man out in Asian emerging markets. So if you want to sort of queer the pitch for foreign investors, this certainly would give them jitters about about an unconventional policy introduction quite abruptly. My own sense is if you mess around with LTCG, you do it immediately after elections. To do it in the 12-month run-up to elections, to do it at a time, as Hiren is saying, where you'll probably target 1 trillion rupees of disinvestment, will certainly be a very counterintuitive move, right? We've seen a few counterintuitive moves from the powers that be in the recent past, but this will be up there. You want 1 trillion of disinvestment, but hey, long-term capital gains tax. So I think I agree with Hiren. I don't think it makes sense in the current context, the current environment. One day, perhaps, the time will be right, but it doesn't feel like today is the right time for this.
Also, I think the point that he made, and Pranav Seta from ENY was making, that if LTCG comes in, it comes in with STT moving out, and that's a sizable chunk of revenue that will go out as well. You arguably can't have both in the same frame. So therefore, the net revenue intake is fairly minimal.
Yeah.
Right. So that is one point, Hiren. The second point is, while rational or irrational or symbolic or otherwise is a separate point, the impact that such a move has on equity markets, not really in terms of whether the investment cycle gets disrupted from an equity side, but the near-term points impact. I mean, do you think this move, if it comes about, has the potential to derail or maybe, take off 5-10 percentage points?
As they say, if the markets have to correct, they'll correct, and then you'll find a reason. So this could be that reason. I mean, we've had a one-way market since the demonetization lows. People have been, waiting for the much-wanted correction. That hasn't come. This could be a trigger for a healthy correction in the stock market. So if you're asking me, I don't see a long-term impact, but are you asking can this be a catalyst for a correction? It could well be. I mean, if they do announce. I mean, and some of the froth in the small and the mid caps could get corrected and disciplined as a result of that.
That's already showing signs of that maybe the last couple of days. I mean, I'm just trying to figure out what are the big numbers that the market is working with. I thought LTCG was one probably, if at all it comes about, or GST revenues were other. What about disinvestment? Both of you brought up that point. I think the last statement that came out 2 days ago from one of the government officials was that we'll comfortably meet the 72,000 number, and which were maybe until the end of December was in doubts. I think maybe they are taking into account the HPCL ONGC deal as well. But is the state set for an ambitious target for FY19 as well? You think 1 lakh odd crores is in the anvil?
I think they have no choice. I think they will have to have a punchy number, because if you look at GST revenues, there's still a degree of opacity. There's still a degree of uncertainty on exactly which direction GST revenues are going in. On direct tax revenue collections, you've had a good run, but you can't expect direct tax collections to give you, even another 18, 19, 20% next year. So even if you bank on healthy direct tax collections, because of your lack of visibility on GST, I think you'll have to pin your hat on a big number on disinvestment. And given the state of the stock market, why not? I mean, if you've pulled off 72,000 crores, I don't see why they shouldn't bank on 1 trillion rupees of disinvestment in the year to March 19. It seems like the right thing to do given the level of bullishness in the stock market, and also it's the right direction in the country to go in. Increasingly, the public sector companies get owned by the broader stock market rather than by the sovereign.
Okay, Hiren, any thoughts here?
No, I think I agree with him. I think they will gun for a higher number, and they don't have a choice, frankly. I mean, because there is no other, tinkering that they can do. They've had to bring down GST rates on several items, so there is some bit of loss there, and they kind of took the leg off the pedal by delaying the e-way bill. But as you see in India, I mean, you don't discipline people. They will just do what they have to do. So, I think given the uncertainty around the indirect taxes and the limited headroom on direct taxes, the only way is to do aggressive disinvestment.
Okay, so now having said that, there are two facets to this, right? One is what they do on the agri front, and history, if at all shown, is that if you don't focus on the rural markets, symbolic as it may be in a pre-election year, then it may not be in the best interest. Two, there is a fundamental need to do that, to give a bit of an agri-rural push as well. And then the other bit is, as I was saying, when corporate India is saying that private sector is not going to do the heavy lifting, it will have to come in from the government's end. So let's split this into two. Start off with the rural push. That is the no-brainer. Almost everybody expects it to happen. In which shape and form can it happen? Saurabh, if I can start off with you on this.
So we've been hearing that this Bhavantar scheme in MP, Madhya Pradesh, which results in the government paying the shortfall to the market price. I think the Bhavantar scheme seems to be very popular with farmers in MP. It was introduced a couple of months ago, and it would appear that some sort of MSP plus a juiced up MSP scheme, perhaps along the lines of the Madhya Pradesh scheme, could be rolled out nationally. I think the states will be given the money; they'll be told to implement it, but it does appear that the MSP scheme will have to be juiced up, enhanced, given rising rural distress and discontent. On the capex cycle, I think Bharatmala has already been announced. To be fair to the government, they did a very good job in their first 2 or 3 budgets on government capex. It's not evident to me there is that much fiscal headroom for the government to do even more on capex. And also, we are at the stage of the economic cycle where private sector picking up the capex slack would seem more likely than not. So, for example, in the steel sector, you've got rising global prices, you've got some demand recovery in India, you've got all of these mothballed NCLT steel companies up for sale. So there is reason to believe that in metals, you'll see the beginnings of a capex cycle over the next couple of years. In the auto sector, we'd have a reasonable run, so beginnings of auto sector capex is also coming back. So the government did what it could in 2014, 15, 16. On the capex growth front. Government capex grew by a good 20% in those 3 years. I think it's a little unfair to say the government will keep doing it year after year. We simply don't have that sort of fiscal resources as a country. And Bharatmala in any case has been announced and is being implemented. So I doubt there is incremental surprises on the capex side. Whatever little surprise, positive surprise will be on the rural front, on the pro-poor and the social security front.
Can there be a surprise though, Hiren? Because almost everybody, and I think Saurabh laid it out as well, almost everybody believes that there will be, if not a normal, then if not a larger than life, then a normal push for agri and rural that will come in. So the street is already working with a fair degree of push that the government will have to do and will do on the rural stroke agri front.
Look, I think both from a politics perspective and from an economics perspective, the fastest thing that you can move in an economy like India is consumption, right? So you lower taxes, or you kind of put money into the hands of people, in whichever form. So I think whether it is, as he mentioned, a scheme for higher MSPs, and maybe there will be some noise around a larger allocation to Narega given the noise around employment, right? So these two will be used as the tools to put and then enhance credit to the agriculture, to the rural and agriculture sector. So, it could be in the form of subvention, of interest, or so on and so forth. Use some of the PSU banking system to say that, okay, we are giving you capital, but, here is what you're going to focus on, and essentially get the flow of money going into the rural through some of these schemes, thereby spur consumption. And once you spur consumption, your capacity utilization goes up and the capex cycle by the private sector kicks in, because as he rightly said, there is only that much that the government can do on its own balance sheet. And to be fair to them, they've been doing it. I mean, there's no reason why, you've already hit your deficit numbers, within the 8 or the 9 months of the fiscal year, because you basically upfronting all the capex that you had, hoping that the revenues will come in. So I think given the uncertainty around GST revenues, there is only that much that the government will be able to do. And I think the slew of FDI reforms that we've seen, I think one of the thinking of PM Modi has been that get foreign capital in whichever way, in whichever manner that you can, right? So they've been progressively opening up the FDI floodgates to supplement the local capital with foreign capital. And I think that even though globally interest rates are inching up, but the differential is still good enough. So there are certain levers that you still have which you can use to kind of pump prim, and attract capital, foreign capital into this country. So I think that it'll be I would say more than a capex oriented budget, which it was in the last 3-4 years. It'll be more a consumption oriented budget, one way or the other.
Interesting. While we're on the topic, while it's an off budget item, this FDI thing that you spoke about, Hiren, this talk of increasing the FDI limits in banking, you think it's while they may contemplate it, the RBI is known in the past to not be approving of such a move. If I'm not wrong, in 2015, such a move was contemplated and the RBI did not go ahead or did not allow that. What are your thoughts here?
I mean, I don't know what the RBI will or will not do, but I'm sure that this is more aimed at this point in time at the private banks. Where there is an appetite for foreigners to own more of the private banks. We've seen that with Bain trying to put in money into Axis. So I think it's likely to help the top 5-6 private sector banks in the country. HDFC Bank has an aggressive fundraising. There was some issues around it being foreign owned and stuff like that. So all that will go away if this is indeed made into policy. So I think the idea is that they want to get as much foreign capital into this. Now public sector banks at 49%, I don't know if people are going to jump over each other to go to come and buy chunks of the public sector banks, because that headroom was always available.
Sure.
So I think the play is going to be either the larger, and then maybe over a period of time, because of bank consolidation, you might find the smaller private sector banks come into play as a result of this.
Okay. Moving back to budget, one other thing that a large corporate told us was that his effective tax rate, Saurabh, was, if I'm not wrong, he said 400 basis points higher than what he was paying maybe 2 or 3 years ago. The FM in year 1 did lay out this roadmap or announcement that corporate tax will be cut. Does he have the headroom to do that this budget?
I mean, to be fair to the FM, the last budget for companies with turnover below 50 crores, I think he cut the corporate tax rate to 25%. I can't see a bigger cut. I can't see a cut in that item. Plus, remember, you've also set up a direct tax committee on the other side of the elections, and you'll unveil a new DTC code, and you've set up a new finance commission. So with those sorts of heavyweight bodies, waiting to opine on what our tax structure will be for states versus center, direct tax construct, I doubt there'll be too many fireworks on the corporate tax rate, or indeed on income tax. I think other than some token reduction in income tax at the lower slabs, or perhaps increasing the threshold of income tax, I don't think on direct taxes there'll be too much action in this budget.
Okay, so we could get into a lot of chat about what specific sectors would, but I don't want to make this platform a conversation of that. There's something expected on insurance, and then a clutch of other construction names, so on and so forth. But the larger question would be, if it's a status quo, Hiren, on the budget front, which is no tinkering with LTCG, fisc is not too much out of shape, and which both of you believe it will not be. Is it business as usual? And then therefore, what is business as usual? Does the market worry about the heady, punchy valuations that we are at? Or will this quarter and next quarter earnings growth set the pace for FY19 and therefore no causes for worry?
So I think if it's, if it's business as usual, then, the baton would move to what's happening. We are in some sort of a synchronized global rally, right? So it'll depend on what's happening, globally. And obviously within that context, what's happening to earnings in India. So we are seeing, reasonably good earnings coming through in some of the early names that we've seen so far. But the market already anticipated some of that, well in advance. So I think if the global bull market rally continues, then we will play in sync with that. I mean, I don't think we will do anything different. And maybe then the budget turns out to be one more event where it, where they say, it climbs another wall of worry and reaches a new high. And then whenever it has to eventually correct, it will. So yeah, I mean, I think people will forget it after maybe a week or so or even shorter than that nowadays.
Shorter than nowadays, maybe the next day. Saurabh, if I'm not wrong, and the last interaction that we had, you were not too constructive on the markets. I think the markets as of now are trading above what was your fair valuation for calendar year 18, if I'm not wrong.
Yeah.
Now, what's the stance now? Again, assuming that the budget turns out to be a non-event, and no bad news is probably good news.
I think Jeremy Grantham of GMO said it very nicely on 3rd January. He says we are in a global melt-up.
Yeah.
So I don't think people like me and my views on valuation matter anymore.
That's okay. I like it.
So valuations clearly have nothing to do with reality. If you look either Nifty, Sensex, you're at 23, 24 times. You're 2 standard deviations above your 10-year average. There is no rational basis on which you can justify, not just our market, S&P 500 I think is in similar territory, highest S&P 500, most expensive since 1929, our market most expensive since I think 2000. So across the world, as Hiren is saying, as Mr. Grantham has said, we're in a melt-up, we're in a synchronized global recovery. So yes, I think the market's overvalued, but that doesn't really matter. I think what matters is confidence, which there's plenty of. What also matters is there a recovery happening in our country? And the answer in that is unquestionably yes. We are especially on discretionary consumption, especially on sectors like metals, on construction. You can clearly see the recovery panning out. You can see corporate confidence, consumer confidence improving. So that will drive even more animal spirits in the stock market. Because as it is, you're bullish, you've made money in the last 2 years. Around you, you see earnings growth improving, GDP growth improving. You don't really kill yourself trying to calculate the PE multiple and comparing to the 10-year average. You just say, let's party.
Yeah, well, Grantham also said that for a US investor, while the melt-up is on, if you think in US is expensive, go and buy the emerging markets, right? In the same piece,
there you go.
He was very bullish on the emerging market.
So I don't think I've seen my foreign clients so happy in last 10 years. Because globally they are making money, I think it's the first sort of signs of, first big set of smiles I've seen amongst our foreign clients since the Lehman tragedy a decade ago. It's a remarkable time. It's the first sign of the real frenzy and complete bullishness taking hold of both global and Indian equity markets.
Well, let's hope from a bull's perspective, let's hope the party lasts. But gentlemen, thank you so much for taking the time out and being with us. As I said, this talk could have been a lot about micros as well, but let's restrict it to the macros and talk to you about them. Thank you so much for taking the time out, Hiren, as well as Saurabh and viewers. Thanks for tuning in on to this budget special.